So I wanted to do a quick blog today and speak to Tim Munro, who's the CEO of Change Accountants and Advisors, about mistakes that people make when investing. And Tim has 20 or 30 years experience in the industry, so he's seen it all. And I've seen it in my 5 years, but Tim has even more insights than I do. So Tim, I just wanted to ask you about mistakes that you've seen, especially during the GFC period and things like that. Like if you'd seen just things that people just did wrong, and if they had their time again, maybe they wouldn't have done.
Definitely. Well, look, first thing is that people need to have, or remember when you're investing, we're doing it for the longer term. If you're going to invest for 2 years, we wouldn't recommend shares or property or other things. We'd recommend just cash or term deposits. So we need to remember it's for a longer period of time. That's the first thing. And then the markets will always go up and down every now and then. And the worst thing in the world is that we don't want any of our clients to panic when things go like this, because they will go like that. And if that's the sort of investor you are, we don't want to get you to lose sleep at night. So it's really important to remember we're doing it for the long term. There are going to be ups and downs. We're going to be here behind the scenes to help you to make certain that your investments are the best rated investments you can get. And we're going to recommend from time to time that you change those as better rated investments come on board. And that way, at least we'll be keeping going in that right direction. Now, the second key thing is never be forced to sell. And this was a big thing from the GFC, because a lot of people, they borrowed a lot of money, and whether it's on shares or property. I know some people had, and we didn't recommend this, but people had properties borrowed up massively and borrowed as much as they could for a second and third, fourth and fifth one. And then GFC hit and property prices came down. And all of a sudden, money had to be paid back. So all the poor people out there were forced to sell houses that were worth this, now for a much lower amount. And so the key thing I learned from the GFC is that for ourselves and for our clients, never be put in a position where you have to sell. If the markets go down in shares or property, you've got to be able to ride it out. And if you ride it out, the markets will then come back up and you're not forced to sell. Same if you have investments with a margin loan. What a lot of people did was they borrowed too much, and so when the prices came down, they had to sell. If you can have enough buffer and you can ride these things out, and property and shares, they'll always be up and down over time. But if you can ride it out, if you're never forced to sell, then you're in a much stronger position to grow your wealth for the future.
Yeah, I completely agree. It's exactly right. You need to be able to ride out any difficult periods of time. So something else that I wanted to ask, because you're an accountant as well as a financial advisor, what does tax implications have to do with it? Because there's capital gains tax and income tax and things like that. So when you're investing, especially over the long term, what might you consider with tax implications?
Well, there's a couple of things. Like I'd kind of even start from an asset protection point of view. This is where a lot of people miss the boat with their advice. And as accountants, we think of asset protection and tax. So think of asset protection. Should an asset be held in mum's name or dad's name? Who's the higher income owner? Who's the lower income owner? Should it be in joint names? Should it be held in a family trust? Should it be held in a company to cap your tax at 27.5% or even lower? Should it be held in a self-managed super fund? So there's a whole range of things to consider first of all. And there's no one easy answer for everybody, because there's different outcomes for different people. So we're not going to automatically recommend an investment in the name of a high income earner, because if you've got a doctor that might be on a top marginal tax rate, and then we put investments in their name, and then they get sued or something goes wrong, forget tax. The whole investment could be taken, and if the doctor goes bankrupt. So we need to think ahead. Where can we put the investments in an area where it's protected so they can grow? And then where can we get the best tax flexibility so we can reduce tax or keep it to as low as we can throughout the years, and then at the end when it gets sold. So we're thinking exit as well. When we're buying an asset, what happens when we exit and sell the asset? Where will the capital gain go, and how can we reduce it then? So a whole range of things we consider.
Yeah, exactly. I think the biggest thing for me is that there's so many different tax implications that you probably, on face value, you don't consider.
Yeah.
You don't really think about the CGT on something when you buy it at age 30 and you're going to hold it for 30 years. But when you plan for the future, that's what you've got to do. You've got to think about the tax implications.
Yeah, look, the key thing, Stephen, is flexibility. So if you've got, say, for argument's sake, and this isn't advice, but if you put an asset in a family trust and it grows, if you hold it for more than 12 months, and if it's an investment asset, you will only be taxed on half of the gain. So half of it will be tax-free, half will be taxable. Now, a family trust then allows you to get the tax-free amount out to mum or other beneficiaries and knock it off the home loan or whatever else you might want to do. And the taxable amount, you can then choose who pays the tax on it. Say mum's got a high income and dad's at home with the kids, well, you can then allocate that money to dad and he will pay it at a lower tax rate than if you gave it to mum who could be on the high tax rate. So that's the flexibility of using a family trust. And while it costs a little bit to set it up and a little bit on an ongoing basis to maintain, it might save you, tens of thousands or hundreds of thousands of dollars of tax many years down the track.
So another point that you made was you were talking about investment properties, and if you can't afford to buy a really expensive property and have a huge amount of debt. So I just wanted to ask, what are the alternatives? So if you want to get into the property market in the future, or if you want to create some wealth, what can you do now to put yourself in a better position?
Well, there's a number of things. Once again, I suppose it's having a longer term plan. It's looking at what is it that you're actually wanting to buy. And it might, if you focus on investment property, a lot of people get so sucked into, I want to buy something that I would like or I would want to live in. And I think that that's wrong. Unless you're planning to buy a property, in an area that you might retire, so you can plan for that you'll sell your existing property and then move into that down the track. But if you look at property as such, it should be not something we get emotionally attached to, but it's just a tool to give you cash flow for a lifestyle, either now or in the future. So when we think about properties, we need to think about something that's going to give us the best tax deductions. So we generally like new properties, whether they're apartments or houses, that then you can maximise tax deductions for depreciation. However, to get into one of those, that's the first thing, but then we've got to think, how do we get into it? So if you can borrow enough to have 20% for the deposit, it means that when you buy the property, you won't have mortgage insurance on that. Now, with the coalition government that's just been returned to power, one of their things is they've got a policy now that you can actually save 5% for a property, borrow the other 95%, and there won't be mortgage insurance. So everything's just changed in this area. Could be quite good for younger ones getting into the stage of wanting to buy their first property. So you need to think about saving enough to at least have, if you're going to use the new coalition rules, 5% towards your property, plus enough for stamp duty and legals and other things like that. So the sort of things we think about is you can save it in cash. Cash has got very low rates of return. It might be that you save some as cash, transfer it to a term deposit, which might give you 2%. But there are also some other income funds which you could put money into over the space of a few years, and they could give you anywhere 5, 6, 7, 8% sort of return. So it's slightly more risky than cash and term deposits, but it's not like putting money into shares. But it gives you that higher rate of return, and as much as you can save to get to that point, then it might be 18 months, 2 years' time, you've got enough saved as a deposit, and you're ready to go for your new house.
Exactly, yeah.
Or investment property, whatever it might be, yeah.
Exactly right. So what about if you're a 30-year-old now and you have good income and so you've got a bit left over every week to put into some sort of investment, but you don't want to get a property yet because you don't have the funds just yet. But say you want to do it in like 10 or 15 years, what can you do? Like, what are some different alternatives to use to build to that in 15 years?
Well, one of the things we think about straight away is reduce any non-tax deductible debt that you might have, or any bad debt. So bad debt would be credit card debt. So if you're 30-year-old and you want to have, say, for a property, say in 10 or 15 years, but you don't want to be burdened with one right now, first of all, smash your credit cards down. Get rid of credit card debt. If you've, say, borrowed money for a car and the loan's at a high 11 or 12%, get rid of that. Get rid of all those sorts of debts, first of all. And look, it's not going to happen straight away, and we're all impatient. We want to do it yesterday. But the thing is to have a plan. Let's do it over 6 months and be happy that you're working towards that, okay? So from every pay, put aside $10, $50, whatever it might be, and you'll slowly get it down. And also be disciplined with your spending, because a lot of people can go and just smash out money on credit cards and holidays, and that's great. But when you come back and you got 2 or 3 or 5 grand on your credit card, once again, you've got to sort that out. So we have a big philosophy, as you know, one eye out for now, one for the future. So we want our clients and ourselves, we want to enjoy life. We want to do as many of these things now, but have a good plan for the future and to be able to make something we are saving. And when you achieve those milestones of getting the credit cards paid off, or the car loan paid off, that's wonderful. Now, once you've got to that stage, There's lots of different investments that you could do. And here's some examples. You could put money into, a share fund, just a little bit every month, called dollar cost averaging, and it just drips away, $100 a month or whatever it might be. And then it's the power of compounding, which helps to bring that up to a much larger amount in 10 or 15 years' time. So we can work out all the numbers on that and give you some graphs and some spreadsheets, some easy to understand reports, so you can see exactly what you're aiming at. And if we had a 6% rate of return, or whatever the rate of return is, and if you put aside X amount a month, you can have this amount, and then when you've got that amount, you can plan to get into that property. There's 10-year investment bonds, which give you a rate of return which is tax-free if you hold it for more than 10 years. So there's a few different things, and the other thing is shares. Just a good share portfolio of blue chip shares might be, buying $1,000 worth every now and then, or if you've got more, 5,000, whatever it might be. But we can just slowly get you into the market, hold them, look after them, keep your other debts down. That's the way you can save up.
I think the key thing is patience, because you can't, as you said, you can't buy a property tomorrow. But if you think about it over 10 or 15 years, if you earn 6% on an investment instead of 2%, that's actually quite a lot after 10 or 15 years. So that could be the difference between you getting a property when in the future and not getting that property. So
definitely, and look, this is a topic for another recording, but that's why people should look into your super right now. Look at the rate of return. Is it capital stable? Should you really be in something, and this depends on what you're aiming at, should you be in something that gives you a high rate of return so you can achieve those goals that you have? So it comes down to what are your goals, and then matching your investments to meet those. Or you might think, well, hey, I don't want to have money in the market, that worries me. So we can help you understand, you're actually not going to meet your goals in 15 years. You're only going to have this. So you need to be happy with just that. Or if you're not, you need to get out of your comfort zone for that. So that's a really, really critical conversation that a qualified financial advisor like Steve, myself, and the rest of the team at Change Accountants and Advisors, that's the sort of thing that we can help you with, to have those conversations. It's not just getting into shares or getting into investments or insurance or super, but it's just understanding what it is that makes you tick and how we can help you to match your investment style now with your goals for the future.
Yeah, exactly. That was really good. Thanks for that, Tim.
Awesome.
And hope everyone enjoyed watching it. Thanks for watching.
Thank you.